Welcome to your comprehensive study guide for the North Carolina Title Insurance Exam. This guide is designed to be your trusted resource as you prepare for this important step in your professional career. Real estate transactions in North Carolina are complex legal processes. They involve significant financial investments and rely on the certainty that the property title is clear and marketable. Title insurance is the bedrock of this certainty. It protects buyers and lenders from financial loss due to hidden defects in a property's title history. Without this protection, the entire system of real estate commerce would be at risk, leaving parties vulnerable to claims, liens, and unresolved ownership disputes from the past. Passing this exam is your gateway to becoming a licensed professional in this vital industry. Understanding the principles of title insurance is not just about memorizing definitions. It is about grasping the core concepts that ensure secure property ownership. The North Carolina Title Insurance Exam will test your knowledge on a wide range of topics, from fundamental legal terms to specific state statutes. It ensures that every licensed professional has the necessary competence to protect the public and facilitate smooth transactions. This exam is a critical checkpoint, validating your ability to identify potential risks, understand policy coverage, and navigate the legal framework that governs real estate in the state. Your success on this exam demonstrates that you are ready to uphold the high standards required of a title insurance professional in North Carolina. This study guide has been meticulously crafted based on the official exam outline provided by the North Carolina Department of Insurance. We will walk you through each key area, breaking down complex subjects into manageable and understandable sections. Our goal is to make your study process as efficient and effective as possible. We will cover everything from the basic vocabulary of title insurance to the nuances of different policy types and legal descriptions. By following this structured approach, you will build a solid foundation of knowledge, piece by piece. This systematic learning path is designed to build your confidence and ensure you are not just memorizing facts, but truly understanding the material you will be tested on. As you begin this journey, it is important to recognize the significance of your future role. As a title insurance professional, you will be an essential guardian of property rights. You will provide peace of mind to homeowners and lenders, ensuring that their investment is safe from unforeseen title issues. The exam you are preparing for is the first step toward fulfilling this responsibility. It is a challenging but achievable milestone. With dedicated study and the right resources, you can master the required material and approach exam day with confidence. Let's begin this process together and set you on the path to a successful and rewarding career in the North Carolina title insurance industry. This study guide is structured to mirror the official North Carolina title insurance exam outline, providing a clear and logical path through the material. We will begin with the foundational building blocks and progressively move toward more complex topics. Our approach is designed to ensure you develop a deep and lasting understanding rather than just cramming information. Each part of this guide corresponds directly to a major section of the exam. We will start with title insurance terms and concepts, making sure you are fluent in the language of the industry. From there, we will explore the different types of ALTA policies, forms of real estate ownership, and the various rights and interests that can affect a property's title. To make your studying as effective as possible, each section is broken down into clear, concise paragraphs. We use short sentences and straightforward language to explain even the most intricate legal concepts. This guide is not a dense legal textbook. It is an engaging and accessible learning tool. We will explore real-world scenarios and examples to help you connect the concepts to the practical work you will be doing. For instance, when we discuss encroachments or restrictive covenants, we will illustrate how these issues appear in a typical transaction and how title insurance addresses them. This method helps solidify your knowledge and prepares you to apply it correctly on the exam. Beyond simply presenting the information, this guide is built to be an active study partner. We will cover every critical area, including the specifics of legal descriptions like meets and bounds and lot and block, and the various methods of property conveyance, from a general warranty deed to a court-ordered transfer. We will also dedicate a crucial section to the North Carolina statutes and regulations that govern the title insurance business, ensuring you understand your legal and ethical obligations. This comprehensive coverage means there will be no surprises on exam day. You will have reviewed all the necessary components outlined by the state regulators. Our ultimate goal is your success. By following this guide chapter by chapter, you will systematically build the expertise needed to pass the North Carolina Title Insurance Exam. We encourage you to take your time, review each section thoroughly, and use the structure provided to organize your study sessions. The journey to becoming a licensed title insurance professional requires dedication, and this guide is the map you need to navigate it confidently. We will cover the content, explain the context, and provide the clarity you need to walk into the testing center fully prepared. Let's get started on mastering the material and securing your professional license. Before a final title insurance policy is issued, the process begins with a crucial preliminary document known as a binder, or more commonly, a commitment. Think of the binder as a detailed proposal from the title insurance company. It is a temporary agreement that outlines the terms, conditions, and requirements under which the company is willing to issue a full policy. This document is not the insurance contract itself, but rather a promise to provide one once certain conditions are met. It provides all parties in the transaction, the buyer, seller, and lender, with a clear picture of the property's title status before the closing takes place. The commitment essentially says, "We have examined the public records, and here is what we found, and here is what needs to be done for us to ensure this title." Once all the conditions outlined in the binder are satisfied, the title company issues the final policy. The title insurance policy is a legally binding contract that protects the insured party against financial loss resulting from hidden defects, liens, or encumbrances on the property's title. Unlike other forms of insurance that protect against future events, title insurance protects against events from the past. For example, it might cover losses from a forged deed in the chain of title or an undiscovered heir who later claims ownership. There are different types of policies, such as an owner's policy for the home buyer and a loan policy for the mortgage lender, each tailored to protect the specific interests of the insured party. This contract is the ultimate safeguard for a property owner's investment. Within the binder and final policy, you will find a section listing specific exceptions. An exception is an item or condition related to the property that the title insurance policy will not cover. These are specific risks that the title company has identified and is explicitly excluding from its protection. Common examples include public utility easements that allow power companies to run lines across the property, or certain recorded restrictions on how the land can be used. Other exceptions might include known liens that have not yet been paid off, or matters that a physical inspection or survey would reveal. It is vital for the insured to carefully review these exceptions to understand the exact scope and limitations of their coverage. Finally, the binder will list a set of requirements. These are specific actions that must be completed before the title company will issue the final policy and assume the risk. Requirements are essentially a to-do list for the closing. For instance, a common requirement is the payment and satisfaction of the seller's existing mortgage, ensuring that the old loan is cleared from the property's title. Other requirements might involve recording the new deed to officially transfer ownership, obtaining necessary legal documents like a death certificate for a deceased owner, or resolving any outstanding judgments against the current owner. Fulfilling these requirements is the final step in clearing the path for a secure and insurable real estate transaction. While a standard title insurance policy provides a broad layer of protection, sometimes a transaction has unique characteristics that require additional or modified coverage. This is where an endorsement comes into play. An endorsement, also known as a rider, is an amendment or addition to the standard policy. It is used to add specific protections, remove certain standard exceptions, or otherwise customize the policy to fit the needs of the insured. For example, a lender might require an endorsement that provides coverage for zoning issues, ensuring the property's current use complies with local ordinances. Another common endorsement might provide affirmative coverage over a known issue, such as a minor encroachment, giving the insured protection against future loss related to it. To accurately assess the property and identify potential risks, a surveyor's report is often essential. This detailed document is created by a licensed surveyor and provides a map of the property, showing its precise boundaries, the location of all buildings and improvements, and the position of any easements or encroachments. The surveyor's report is a critical tool for the title company because it reveals physical conditions that are not apparent in the public records. For instance, a survey might uncover that a neighbor's fence is built several feet onto the insured property, or that the homeowner's new garage violates a setback line. This information helps the underwriter decide which exceptions to include, or which endorsements might be necessary. In North Carolina, the closing process is typically handled by an attorney. To protect the parties who entrust their funds to this closing agent, a closing protection letter, or CPL, is issued. A CPL is a separate agreement from the title insurance underwriter that indemnifies the lender and buyer against losses caused by the closing attorney's misconduct. Specifically, it protects against fraud, dishonesty, or failure to follow written closing instructions. For example, if the closing attorney failed to pay off the seller's mortgage, the CPL would protect the lender from having to cover that loss. This letter provides an essential layer of security, ensuring the integrity of the closing process itself. The state of North Carolina operates under an approved attorney system for title insurance. This means that a title insurance policy can only be issued based on a title opinion rendered by a licensed North Carolina attorney who has been approved by the title insurance underwriter. The attorney is responsible for conducting the title search, examining the public records, and providing a legal opinion on the status of the title. The title company then relies on this opinion to issue its commitment and final policy. This system ensures that a qualified legal professional has reviewed the title history before insurance is provided, adding another layer of diligence and protection to the transaction. Aspiring agents must understand this collaborative relationship between attorneys and title companies. One of the most common physical title issues discovered during a survey is an encroachment. An encroachment occurs when a structure or improvement belonging to one property owner illegally intrudes onto the land of another. A classic example is a driveway, fence, or shed that was built partially over the property line. Encroachments can create significant disputes between neighbors and cloud the title to a property, making it difficult to sell. If an encroachment is discovered before closing, the title company will typically list it as an exception, meaning it will not provide coverage for any future legal issues arising from it. Resolving an encroachment might require moving the structure, creating a formal easement agreement, or even legal action. Another important boundary limitation is the building setback line. A setback line is a legally mandated distance from a property's boundaries, such as the street, a side yard, or a rear lot line, within which no structures can be built. These lines are established by local zoning ordinances or by recorded subdivision plats to ensure properties have adequate space for light, air, and access. For example, a town might require all houses to be set back at least 25 feet from the front property line. Building a porch or an addition that violates this setback line can lead to legal trouble, including orders to remove the offending structure. A title policy may contain an exception for any loss or damage arising from the violation of a setback line. Beyond physical boundaries, a property's use can be limited by restrictive covenants. These are conditions or limitations written directly into a deed or a separate recorded document that dictate how a property can and cannot be used. Restrictive covenants are common in subdivisions and planned communities, where they are used to maintain a certain standard of appearance and quality of life. For example, covenants might prohibit commercial activities, limit the number of pets, specify the type of fencing allowed, or require that all home exteriors be painted in approved colors. These restrictions run with the land, meaning they are legally binding on all future owners of the property, not just the original purchaser. When issuing a title policy, the title company will list all recorded restrictive covenants as exceptions to coverage. This means the policy does not protect the owner from the enforcement of these rules. If a homeowner violates a covenant, for instance, by building a shed that the community's rules forbid, they cannot turn to their title insurance for protection against any resulting fines or legal action from the homeowners association. It is therefore critical for a buyer to review and understand all restrictive covenants before purchasing a property. As a title professional, you must be able to identify these covenants during the title search and ensure they are properly disclosed in the commitment. The American Land Title Association, or ALTA, has developed standardized policy forms that are used throughout the nation, including right here in North Carolina. The most fundamental of these is the owner's policy of title insurance. This policy is purchased for the benefit of the new property owner, typically the buyer in a real estate transaction. Its purpose is to protect the owner's equity in the property against title defects that existed before the policy was issued. For example, if a previously unknown heir comes forward with a valid claim to the property, the owner's policy would defend the owner's title and cover any financial loss up to the policy amount, which is usually the purchase price of the home. This protection lasts as long as the owner or their heirs hold an interest in the property. While the owner's policy protects the buyer, the loan policy protects the mortgage lender's financial interest. If a buyer is financing their purchase, the lender will almost always require a loan policy as a condition of the loan. This policy ensures the lender against any title problems that could jeopardize its security interest in the property. For instance, if a prior lien was missed during the title search and later surfaces with priority over the lender's mortgage, the loan policy would protect the lender from financial loss. The coverage amount for a loan policy is typically the amount of the mortgage and decreases as the loan is paid down. It terminates completely once the loan is paid off. For residential properties, buyers often have the option to purchase a homeowner's policy of title insurance. This is an enhanced version of the standard owner's policy, offering more comprehensive coverage for a slightly higher premium. In addition to protecting against pre-policy title defects, the homeowner's policy provides certain types of post-policy coverage. This can include protection against someone building a structure on your land without permission after you buy the property, or losses due to the enforcement of restrictive covenants that you are not aware of. It also often includes automatic inflation coverage, which increases the policy amount over time to reflect the property's appreciation in value, providing more robust long-term protection for the homeowner. Finally, there is the short-form residential loan policy. This is a simplified one-page version of the standard ALTA loan policy. It is most commonly used in residential refinance transactions where the property has not changed hands and a previous title search has already been conducted. The short form incorporates the terms of the full loan policy by reference, but it streamlines the documentation process for lenders. It provides the same fundamental protections to the lender as the standard loan policy, but in a more concise format. Understanding the distinctions between these core policy types is essential, as you will encounter each of them regularly in your work as a title insurance professional in North Carolina. Every ALTA title insurance policy, regardless of type, follows a standardized format that makes it easier to understand the scope of coverage. The heart of the policy is the Covered Risks section. This is an itemized list of the specific title-related issues that the policy protects against. These risks typically include protection against a title being vested in someone other than the insured, defects or liens on the title, unmarketable title, and lack of a right of access to and from the land. It also covers losses from forgeries, fraud, duress, incompetency, or incapacity related to a past transaction in the chain of title. This section clearly defines the promises the title company is making to the insured. Conversely, the exclusions from coverage section lists matters that the policy will not cover under any circumstances. These are general risks that are considered outside the scope of title insurance. Common exclusions include losses arising from governmental police power, such as zoning ordinances or building codes, unless a specific notice of enforcement was filed in the public records at the policy date. Other standard exclusions are rights of eminent domain, defects created or agreed to by the insured party, and title matters that arise after the policy date. It is crucial to distinguish these broad exclusions from the specific exceptions listed in Schedule B, which are tied to the individual property. The conditions section of the policy contains the legal and procedural rules that govern the relationship between the title company and the insured. This section is essentially the rule book for how the policy works. It includes definitions of key terms used in the policy, explains the insured's duty to cooperate in the event of a claim, and outlines the specific steps for submitting a notice of claim. The conditions also detail the title company's options for resolving a claim, such as paying the claim, defending the title in court, or paying the policy limits to the insured. Understanding these provisions is vital for both the insured and the title professional when a title issue arises. Finally, the policy is organized using schedules that provide the transaction-specific details. Schedule A is the face page of the policy. It identifies the date of the policy, the amount of insurance coverage, the name of the insured party, the owner or lender, and the estate or interest being insured, like fee simple. Most importantly, it contains the full legal description of the insured property. Schedule B then lists the specific exceptions for that particular property. These are the items discovered during the title search, such as easements, covenants, and existing liens that are being excluded from coverage. Schedule B is where the unique characteristics and encumbrances of the property are formally disclosed. In North Carolina, the premium for a title insurance policy is a one-time fee paid at the real estate closing. Unlike other types of insurance that require ongoing monthly or annual payments, a title insurance premium purchases protection that lasts for as long as the insured holds an interest in the property. The premium amount is regulated by the North Carolina Department of Insurance and is based on a sliding scale tied to the property's purchase price for an owner's policy and the loan amount for a loan policy. When an owner's policy and a loan policy are purchased simultaneously, a reduced simultaneous issue rate is often available, offering a significant cost saving for the consumer. The standard ALTA policy forms provide a strong baseline of protection, but many transactions involve unique circumstances that require tailored coverage. This is accomplished through the use of endorsements. An endorsement is an add-on or amendment to the policy that modifies its terms, either by adding coverage or removing an exclusion. There are dozens of different ALTA endorsements available, each designed to address a specific risk. For example, a lender may require an ALTA 9 endorsement, which provides comprehensive protection against violations of covenants, encroachments, and setback line issues. Another common one is an access endorsement, which ensures that the property has legal, physical access to a public road. Endorsements are a critical tool for both residential and commercial transactions, allowing the title policy to be customized to meet the specific needs of the insured and the lender. For instance, if a survey reveals that a neighbor's shed encroaches onto the property by a few inches, the buyer might be concerned. The title company could potentially offer an endorsement that provides affirmative coverage, ensuring the buyer against any financial loss if they are ever forced to remove the shed or defend their title because of that specific encroachment. Each endorsement typically comes with an additional separate premium, and its availability depends on the underwriting guidelines of the title insurance company and the specific facts of the transaction. As a title insurance professional, you'll need to become familiar with the most common endorsements used in North Carolina and understand when they are appropriate. You'll work with lenders and attorneys to identify potential risks and determine which endorsements are necessary to provide adequate protection and satisfy the lender's requirements. This process of customizing the policy ensures that the final coverage is a perfect fit for the property and the transaction. It transforms the standard policy into a highly specific instrument of protection, giving all parties the confidence they need to proceed with the closing, knowing that their respective interests are secure. When we talk about owning real estate, the most complete and powerful form of ownership is known as fee simple. Specifically, it's often called fee simple absolute. This type of ownership grants the owner the maximum bundle of rights legally permissible. A person who holds title in fee simple has the full right to possess, use, enjoy, and dispose of the property as they see fit, subject only to governmental powers like taxation and eminent domain, and private restrictions like covenants. They can sell it, lease it, give it away, or pass it on to their heirs through a will. From a title insurance perspective, insuring a fee simple estate is the most common scenario, as it represents the highest form of ownership a buyer can acquire. A slightly more complex form of ownership is the life estate. A life estate grants ownership rights to a person, known as the life tenant, for the duration of their life. The life tenant has the right to possess and use the property, and even collect income from it, such as rent. However, they cannot do anything that would permanently damage the value of the property for future owners, an act legally known as committing waste. Upon the death of the life tenant, the ownership of the property automatically transfers to another person or entity designated in the document that created the life estate. This future owner is known as the remainder man. This structure is often used in estate planning to allow a surviving spouse to live in a home for their lifetime, with the property then passing to children. Insuring a life estate presents unique challenges for a title company. The policy must clearly define that the interest being insured is a life estate, not a fee simple estate. The life tenant's rights are limited by their own mortality and by the rights of the remainder man. For example, a life tenant cannot typically sell the property outright without the consent and participation of the remainder man, because they only own the rights for their lifetime. Any title insurance policy issued to a life tenant would be limited to that interest and would terminate upon their death. Similarly, a remainder man could purchase a policy to protect their future interest in the property. In contrast to these freehold estates, a leasehold interest grants the right of possession but not ownership. When a person signs a lease for an apartment or commercial space, they're acquiring a leasehold estate. The tenant, or lessee, has the right to occupy and use the property for a specified period according to the terms of the lease agreement. The actual owner or lessor retains the underlying fee simple title. While less common for residential tenants, commercial tenants with long-term, high-value leases often purchase a leasehold title insurance policy. This policy protects their right to possess the property for the lease term against unforeseen title defects that could lead to eviction. When two or more people own property together, it's known as co-tenancy. The most common form of co-tenancy is tenancy in common. Under this arrangement, each owner or tenant in common holds a separate, undivided interest in the property. These interests can be equal or unequal. For example, one person could own a 75% interest while another owns 25%. Each owner has the right to possess the entire property, and they can sell, mortgage, or will their individual share to their heirs without the consent of the other co-owners. If a deed does not specify the type of co-ownership, North Carolina law presumes it is a tenancy in common. This flexibility is a key feature of this ownership type. Another form of co-ownership is joint tenancy, which is defined by its key feature, the right of survivorship. In a joint tenancy, two or more people own the property with equal shares. When one joint tenant dies, their interest in the property is automatically and immediately transferred to the surviving joint tenant or tenants, bypassing the need for probate court. This right of survivorship is the critical difference from tenancy in common. To create a valid joint tenancy in North Carolina, the deed must contain specific language, such as joint tenants with right of survivorship. Because of this automatic transfer, a joint tenant cannot leave their interest to an heir in their will. North Carolina law provides a special form of joint ownership available only to married couples, known as tenancy by the entirety. This form of ownership is similar to joint tenancy in that it includes an automatic right of survivorship. Upon the death of one spouse, the surviving spouse automatically becomes the sole owner of the property in fee simple. The primary advantage of tenancy by the entirety is the significant protection it offers from creditors. The property is considered to be owned by the marital unit as a single entity, not by the individual spouses. Therefore, a creditor of only one spouse generally cannot force the sale of the property to satisfy that individual's debt. From a title insurance standpoint, understanding these forms of ownership is critical for determining who must sign legal documents and how the title is vested. For a tenancy by the entirety, both spouses must sign any deed or mortgage to validly convey or encumber the property. If a property is held by tenants in common, a title search must verify the ownership percentage of each individual and ensure all owners are involved in the transaction if the entire property is being sold. The way title is held directly impacts the rights and obligations of the owners, and the title policy must accurately reflect this legal reality to provide proper coverage. Beyond direct ownership, a property's title can be subject to various rights and interests held by others, which are broadly known as encumbrances. One of the most common types of encumbrance is an easement. An easement grants a non-owner the legal right to use a portion of someone else's land for a specific purpose. This does not grant ownership, only a right of use. When an easement exists, it involves two distinct properties. The property that receives the benefit of the easement is known as the dominant estate. For example, if a property is landlocked, it may have an easement across a neighbor's land for access to a public road. In this case, the landlocked property is the dominant estate because it benefits from the right of way. Conversely, the property that is subject to the easement or has its use limited by it is called the burdening or servient estate. In our landlocked example, the neighbor's property that allows the access road to cross it is the servient estate. It is burdened by the easement. Easements are typically recorded in the public records and run with the land, meaning they remain in effect even after the property is sold to a new owner. During a title search, an attorney will identify all recorded easements, and they will be listed as exceptions in the title insurance commitment and policy. This disclosure ensures the new owner is aware of the limitations on their property rights. Another major category of encumbrance is a lien. A lien is a legal claim against a property that serves as security for the payment of a debt or obligation. If the debt is not paid, the lien holder can force the sale of the property to satisfy the debt. Liens can be categorized as either specific or general. A specific lien attaches to a single particular piece of property. The most common example is a mortgage or deed of trust, where the property itself is used as collateral for the home loan. Other specific liens include real estate property tax liens and mechanics liens, which are filed by contractors who have not been paid for work done on that specific property. In contrast, a general lien attaches to all of a debtor's property, both real and personal, within the jurisdiction where the lien is recorded. General liens are not tied to a specific asset, but rather to the person. Common examples include judgment liens, which result from a lawsuit where a court awards a monetary judgment to a creditor. If the debtor does not pay, the creditor can record the judgment, and it becomes a general lien against any real estate the debtor owns in that county. State and federal tax liens are also general liens. A title search must uncover all liens, both specific and general, and the title policy requirements will mandate that they be paid and released before a clear title can be ensured. As communities become more densely populated, different forms of unit ownership have become increasingly popular. One of the most prevalent is the condominium. When you purchase a condominium, you acquire fee simple ownership of the airspace within your individual unit. You also acquire an undivided interest, as a tenant in common with all other unit owners, in the shared common areas. These common areas typically include things like the land beneath the building, hallways, elevators, swimming pools, and the building's exterior. Ownership in a condominium is governed by a detailed declaration and bylaws, which establish the rules for the community and create a homeowners association to manage the common elements. A townhouse is another form of unit ownership that can sometimes be confused with a condominium, but there are key differences. In a typical townhouse development, the owner purchases not only the interior of the unit, but also the land directly beneath it. The ownership structure can vary. Some townhouses are part of a condominium regime, while others are set up in a planned unit development, or PUD, where owners hold title to their individual lots. Maintenance responsibilities can also differ. Townhouse owners might be responsible for their own exterior walls and roofs, whereas in a condo this is usually covered by the association. The title policy must accurately describe the specific type of ownership and the associated rights and obligations. A timeshare represents a unique form of property rights where multiple parties hold rights to use a property, typically a vacation condo or resort unit, for a specific allotted period each year. In North Carolina, timeshares are legally defined as the right to occupy a unit for at least 5 separate periods over a span of at least 5 years. Ownership can be structured as a deeded interest, giving the buyer a fractional fee simple ownership, or as a right-to-use interest, which is more like a lease or a license for a certain number of years. Due to their complexity and potential for sales practice issues, timeshares are heavily regulated under the North Carolina Timeshare Act, which provides certain consumer protections, like a 5-day cancellation right. Beyond these formal ownership structures, property can be affected by a variety of private rights. These are non-governmental limitations or permissions that impact how the land can be used. We have already discussed easements and restrictive covenants, which are primary examples. Another type is a license, which is a personal, revocable permission to use another's land for a specific purpose, such as to hunt or fish. Unlike an easement, a license does not create an interest in the property and does not run with the land. A title search is designed to uncover all recorded private rights that could impact the owner's bundle of rights, ensuring they are disclosed to the buyer and addressed in the title policy. A legal description is a precise, legally sufficient method of identifying a parcel of land for a deed, mortgage, or other real estate instrument. It is the cornerstone of a clear title as it defines the exact boundaries of the property being conveyed, insured, or encumbered. While a street address or tax parcel ID number is useful for mail delivery or property tax assessment, these are considered non-traditional descriptions and are not legally sufficient on their own to transfer title in North Carolina. A valid legal description must be so complete that a licensed surveyor could locate and identify the parcel's boundaries using only the information provided in that description. Without this level of precision, ambiguity can arise, leading to boundary disputes and unmarketable title, which is why title insurance relies so heavily on accurate legal descriptions. To achieve this precision, various types of surveys are used to create or verify legal descriptions. A boundary survey is the most fundamental type, involving a professional surveyor mapping the exact property lines on the ground based on recorded documents, monuments, and other evidence. This survey produces a plat or map that shows the dimensions and location of the land. For new construction, a foundation survey is often required. This survey is performed after the building's foundation has been poured to verify that it is situated correctly on the lot and does not violate any setback lines or easements. This is a critical step before construction continues, as correcting a misplaced foundation can be incredibly expensive and complicated. Once all construction and improvements on a property are complete, a final survey is often conducted. This survey shows the location of all finished structures such as the house, garage, driveway, and fences, in relation to the property lines. The final survey is a comprehensive snapshot of the property as it exists at that moment. It is invaluable to a title insurance underwriter because it can reveal potential title issues that are not apparent from the public records, such as encroachments where a neighbor's fence is on the property, or improvements that have been built over a recorded utility easement. This information allows the underwriter to add specific exceptions to the policy or require resolutions before closing. The information gathered from these surveys is what allows an attorney or title professional to confirm that the legal description in the deed accurately represents the property being transacted. An incorrect legal description is a serious title defect that can render a conveyance void or create confusion over ownership for years to come. For example, a simple typographical error in a direction or distance could describe a completely different parcel of land, or one that overlaps with a neighbor's property. Verifying the legal description against a current survey is a fundamental part of the due diligence process in any real estate transaction, ensuring that the buyer is receiving exactly what they bargained for and that the title policy is ensuring the correct piece of land. One of the oldest and most detailed methods for creating a legal description is the meets and bounds system. This method describes the perimeter of a property by starting at a defined point of beginning and then tracing the boundary lines using a series of directions, called bounds, and distances, called meets, until it returns to the starting point, creating a closed shape. Directions are given using compass bearings, such as north 45 degrees east, and distances are measured in feet or other units. The description often references physical landmarks or monuments like iron pins, streams, or roads. This method is commonly used for irregularly shaped parcels and properties in rural areas that aren't part of a formal subdivision. In stark contrast to the complexity of meets and bounds is the lot and block system, which is the standard method for describing properties within platted subdivisions. When a developer creates a new residential or commercial subdivision, they record a detailed map, or plat, in the public records. This plat map shows the entire development divided into numbered or lettered blocks, which are further divided into numbered lots. The legal description for a property in this subdivision then simply needs to reference the lot number, the block number, and the name and recording information of the subdivision map. For example, a description might read, Lot 5, Block B of Happy Acres subdivision, as shown on plat map recorded in Book 68, page 123 of the county registry. The lot and block system provides a much simpler and more efficient way to describe property compared to meets and bounds. Because the detailed survey work is all contained within the recorded plat map, the legal description itself can be short and unambiguous. Anyone wishing to see the exact dimensions and location of the lot can simply look up the reference plat map in the public records. This system is really the backbone of modern urban and suburban land development. As a title insurance professional, you will frequently encounter lot and block descriptions and will need to know how to locate and interpret the corresponding plat maps to verify property details. While meets and bounds and lot and block are the two primary legally sufficient description methods in North Carolina, it's important to recognize their roles. Often a property may have a description that uses both systems. For instance, the original parcel of land for a subdivision may have been described by meets and bounds, and the lots within it are then described by lot and block. Understanding both systems is essential for a title professional. You must be able to read and interpret these descriptions to ensure the property being insured is accurately and legally identified in all documents, preventing the risk of a title defect related to the property's very definition. The most common method of transferring real estate ownership from one person to another is through a legal document called a deed. A deed is the written instrument that conveys title to real property. In North Carolina, several types of deeds are used, each offering a different level of protection to the recipient, known as the grantee. The highest level of protection is provided by a general warranty deed. With this deed, the grantor makes several covenants, or promises, guaranteeing that the title is free from all defects, not just those that arose during their period of ownership, but all the way back through the property's history. This is the most desirable deed for a buyer. A step down in protection is the special warranty deed. With this deed, the grantor warrants the title only against defects that arose during their time of ownership. They're not making any promises about the state of the title before they acquired it. This type of deed is often used in commercial transactions or by fiduciaries like executors or trustees. The least protective deed is the quitclaim deed. This deed conveys whatever interest the grantor may have in the property, if any, without making any warranties at all. Quitclaim deeds are typically used to clear up potential title clouds, such as resolving a possible heir's interest. Other specialized deeds serve specific purposes. A trustee's deed is used to transfer property ownership from a trust. A deed of trust is not a conveyance deed but rather a security instrument. In North Carolina, it is used instead of a traditional mortgage. It temporarily conveys title to a third-party trustee, who holds it as security for a loan. A lease is a conveyance of a possessory interest, granting a tenant the right to use the property for a specified term. Property can also be transferred upon the owner's death through estate planning. If a person dies with a valid will, they're said to have died testate. The property is transferred by the estate's executor via an executor's deed. If a person dies without a will, they've died intestate. North Carolina's laws of intestate succession determine how the property is divided among legal heirs. Transferring title in these situations requires a formal probate court process. While most property transfers are voluntary, title can also be conveyed through involuntary or compelled means, often as the result of legal action or the operation of law. One of the most notable involuntary methods is adverse possession. In North Carolina, this doctrine allows a person to acquire legal title to a property they do not own by possessing it in a manner that is actual, open and notorious, continuous, hostile, that is, without the owner's permission, and exclusive for a statutory period of 20 years. This is sometimes colloquially known as squatters' rights. The purpose of this law is to settle land disputes and ensure property is not left abandoned. Acquiring title this way requires a court action to quiet title in the adverse possessor's name. Another common involuntary transfer is foreclosure. This is the legal process a lender uses to recover unpaid debt when a borrower defaults on their loan, which is secured by a deed of trust in North Carolina. The process allows the trustee named in the deed of trust to sell the property at a public auction. The proceeds from the sale are used to pay off the outstanding loan balance, as well as any other junior liens. The winning bidder at the foreclosure sale receives a trustee's deed, which conveys ownership of the property. This action extinguishes the previous owner's rights to the property, transferring title to a new owner against the will of the borrower. The filing of bankruptcy by a property owner can also significantly impact and lead to the transfer of title. When a person files for bankruptcy, a bankruptcy estate is created which includes all of their assets, including real estate. A court-appointed bankruptcy trustee is given authority over these assets. Depending on the type of bankruptcy and the owner's available exemptions, the trustee may be empowered to sell the property to pay off creditors. Any such sale is conducted under the supervision of the bankruptcy court, and the transfer of title would be made via a trustee's deed, overriding the owner's wishes and conveying title to a new purchaser. Finally, title can be transferred as a direct result of a court order. This can happen in various legal proceedings. For instance, in a divorce settlement, a judge may order one spouse to transfer title to the other. In a partition action where co-owners cannot agree on how to manage or divide a property, a court can order the property to be sold and the proceeds divided among the owners. Another example is condemnation, where the government uses its power of eminent domain to take private property for public use, such as for a new highway. In all these cases, the court's decree itself acts as the mechanism for conveying title, compelling a transfer that would not have happened otherwise. The title insurance industry in North Carolina is not self-regulated. It operates under a strict legal and regulatory framework designed to protect consumers and ensure financial stability. The primary source of this authority is found in the North Carolina General Statutes, specifically within Chapter 58, which is also known as the Insurance Law. This comprehensive chapter governs all types of insurance within the state, from health to casualty, and includes articles directly pertinent to title insurance. Aspiring title professionals must have a foundational understanding of this statute as it dictates everything from company formation to specific practices that are permitted or prohibited. Within Chapter 58, two articles are of particular importance: Article 26 and Article 33. Article 26, titled the Title Insurance Company Act, lays out specific requirements for companies wishing to transact title insurance business. It covers capital and surplus requirements, reserve funds that must be maintained to pay future claims, limitations on risk exposure, and rules regarding investments. This article ensures that any title insurer operating in North Carolina is financially sound and capable of meeting its obligations to policyholders. It is the bedrock of the industry's financial integrity. The day-to-day oversight and enforcement fall to a critical state agency, the North Carolina Department of Insurance, or NC DOI. Headed by the elected Commissioner of Insurance, the NC DOI regulates the insurance industry to protect the public interest. For title insurance, the department is responsible for licensing all title insurance companies and individual agents, approving the policy forms and endorsements that can be used, and setting or approving the premium rates charged to consumers. This rate regulation ensures premiums are fair, adequate, and not discriminatory, balancing company solvency with public affordability. Furthermore, the NC DOI has authority to conduct examinations and investigations into the practices of title insurers and agents to ensure compliance with all applicable laws and regulations. If the department finds violations of the statutes, such as charging unapproved rates or engaging in unfair trade practices, it has the power to impose significant penalties. These can range from fines and license suspension to complete revocation of the license to do business in the state. Understanding the powerful role of the NC DOI is essential for any title professional building a compliant career in North Carolina. To legally act as a title insurance agent in North Carolina, an individual must obtain a license from the North Carolina Department of Insurance. The process for obtaining this license is clearly defined by state regulations, and begins with passing the state-administered title insurance licensing exam. This exam is designed to test an applicant's knowledge on all the topics covered in this study guide, ensuring they possess the minimum competency required to handle transactions and protect consumers. After successfully passing the exam, the applicant must submit a formal application to the NC DOI, which includes a background check to verify their character and fitness to work in a position of public trust. This rigorous screening process is the first line of defense in maintaining professional standards. Once licensed, a title insurance agent's obligations do not end. To maintain their license, agents must comply with continuing education requirements set forth by the Department of Insurance. These requirements mandate that agents complete a certain number of hours of approved coursework every 2 years. The coursework is designed to keep agents up to date on changes in laws, regulations, and industry best practices. At least 3 of these hours must be dedicated to the topic of ethics, reinforcing the high standard of conduct expected of insurance professionals. Failure to complete the required continuing education hours in a timely manner can result in the suspension or non-renewal of an agent's license, making compliance a critical part of an agent's ongoing professional responsibilities. Beyond licensing, Chapter 58 outlines specific rules of conduct that all title agents must follow. A key area of regulation involves fiduciary duties, especially concerning the handling of funds. Title agents and closing attorneys often hold significant sums of money in trust for buyers, sellers, and lenders during the closing process. The law requires that these funds be held in separate, properly managed escrow or trust accounts and be dispersed only in accordance with the written closing instructions. Mishandling these funds, known as commingling or conversion, is a severe violation that can lead to license revocation and even criminal charges, as it represents a fundamental breach of trust with the consumer. Finally, state regulations strictly prohibit unfair or deceptive trade practices. This includes activities like rebating, where an agent gives a portion of their commission back to the consumer as an illegal inducement to purchase a policy. It also prohibits misrepresenting the terms or benefits of a title insurance policy, or making false statements about a competitor. The goal is to ensure a fair and transparent marketplace where consumers make decisions based on the merits of the products, not on misleading information or illegal incentives. A thorough knowledge of these rules is not just necessary to pass the exam, but is absolutely essential for conducting business legally and ethically in the North Carolina title insurance industry. As you approach the end of your study journey for the North Carolina title insurance exam, it is time to consolidate your knowledge and refine your strategy for success. we have covered a vast amount of material, from the foundational definitions of a binder and a policy to the intricate details of North Carolina statutes. Your final preparation should focus on active recall rather than passive reading. Instead of just rereading this guide, try to explain the concepts aloud as if you were teaching them to someone else. For example, articulate the key differences between a general warranty deed and a special warranty deed, or describe the purpose of a closing protection letter in your own words. This practice will solidify your understanding and highlight any areas where you still feel uncertain, allowing you to focus your remaining study time effectively. A highly effective final study technique is to create and use flashcards for key terms, legal concepts, and statutory references. This guide has introduced dozens of critical vocabulary words and principles such as encroachment, tenancy by the entirety, and the functions of Chapter 58. By breaking these down into bite-sized pieces of information on flashcards, you can quiz yourself repeatedly, reinforcing your memory. Mix up the order of the cards to ensure you are not just memorizing a sequence. This method is particularly useful for mastering the details that distinguish similar concepts, like the different types of liens or the specific coverages offered by an enhanced homeowner's policy versus a standard owner's policy. Consistent, spaced repetition is a proven path to long-term retention. On the day before the exam, avoid the temptation to cram new information. Your goal should be to review, relax, and build confidence. Do a light-touch review of your notes or flashcards, focusing on the major concepts we have discussed. Ensure you have all your necessary items ready for exam day, such as your identification and admission letter, and confirm the location and time of the test. A good night's sleep is one of the most powerful preparation tools you have. Arriving at the testing center well-rested and calm will allow you to access the information you have worked so hard to learn. Trust in your preparation. You have diligently worked through the material and are ready for this challenge. When you sit down to take the exam, manage your time wisely. Read each question carefully, paying close attention to keywords like not, except, or always. First, answer the questions you are confident about to build momentum and bank time. If you encounter a difficult question, do not let it derail you. Make your best educated guess, flag it for review if the testing system allows, and move on. You can always return to it later if you have time. Remember the principles from this guide, the importance of the approved attorney system, the protections of ALTA policies, and the role of the Department of Insurance. Your comprehensive study will provide the foundation you need to analyze the questions and select the correct answers. Passing the North Carolina Title Insurance exam is a significant achievement, but it is also the beginning of your journey. It marks your entry into a profession that is fundamental to the security and stability of real estate commerce in the state. As a licensed title insurance professional, you will hold a position of great trust and responsibility. You will be the guardian of property rights, providing critical protection and peace of mind to homeowners and lenders. The knowledge you have gained through your studies is not just for passing a test, it is the foundation upon which you will build a successful and ethical career. Embrace this responsibility with the same diligence and commitment you apply to your exam preparation. The field of title insurance is dynamic, with laws, regulations, and industry practices evolving over time. Therefore, your learning must not stop once you receive your license. Commit to being a lifelong learner by staying current with changes from the North Carolina General Assembly and the Department of Insurance. Fulfilling your continuing education requirements is not just a regulatory mandate. It is an opportunity to sharpen your skills, deepen your expertise, and provide the highest level of service to your clients. A knowledgeable and up-to-date agent is an invaluable asset to any real estate transaction, capable of navigating complexities and ensuring a smooth, secure closing process for all parties involved. As you step into your new role, remember the core purpose of your work: to protect against risk. Every title search you review, every commitment you help prepare, and every policy you issue is a promise of security. You are ensuring that a family's largest investment is safe from hidden claims and that a lender's collateral is sound. This work requires meticulous attention to detail, unwavering integrity, and a deep understanding of the principles we have outlined in this guide. Your success will be measured not just by the volume of policies you handle, but by the quality of your work and the confidence you instill in the public. This is a career where you can make a tangible, positive impact every single day. We hope this comprehensive study guide has provided you with the knowledge, structure, and confidence needed to succeed on your exam and launch a rewarding career. The path to becoming a licensed professional is challenging, but with dedicated effort, it is entirely achievable. You have been given the map to navigate the complexities of title insurance in North Carolina. Now, it is your turn to use that knowledge to pass the exam and become a trusted expert in this vital field. We wish you the very best of luck on your exam and in your future endeavors as a North Carolina title insurance professional. Go forward with confidence and build a great career.